Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Now, let us get into it. The machine that was buying Bitcoin on every single dip for 3 years has stopped. Not slowed down, stopped. And if you hold Bitcoin right now, you need to understand what that machine was, why it stopped, and what Bitcoin looks like without it underneath the price. Marcus opened his laptop at 7 a.m. on a Sunday morning in Chicago with a coffee in his hand and one question on his mind. He had bought Bitcoin 2 years ago, not because he was a crypto fanatic, not because he believed it would replace the dollar. He bought it because every serious investor he respected seemed to own some, because the institutional money was pouring in, because the largest companies in the world were putting it on their balance sheets. And for a while, it worked. Bitcoin went from $60,000 to $126,000 in October of 2025. Marcus had more than doubled his position on paper. Now it was sitting at $60,000 again, down 50% from the peak. And Marcus could not shake the feeling that something had changed. Not just the price, the structure underneath the price. He was right, something had changed. And understanding what changed is the most important thing any Bitcoin holder can do right now. Here is a story most Bitcoin investors never heard. Imagine a very unusual vending machine. Every time someone buys a token from this machine, the machine takes the money and goes straight to the Bitcoin market and buys more Bitcoin. It does this constantly, rain or shine, bull market or bear market. Every dip becomes a buy. Every pullback gets absorbed. The machine never sleeps, and it never sells. That machine is called Strategy Inc. You probably know it by its old name, MicroStrategy. From 2020 through early 2026, Strategy became the largest corporate holder of Bitcoin on the planet. As of late June 2026, the company holds 847,363 Bitcoin. That is more than 4% of all the Bitcoin that will ever exist. At its peak buying pace, Strategy was responsible for approximately 97.5% of all net new corporate Bitcoin purchases globally. Every institution that wanted to buy Bitcoin in any meaningful size had to compete with this machine. Think about what that means for a moment. For 3 years, every time Bitcoin fell, one buyer was always there, absorbing the dip, providing a permanent demand floor. The market knew the machine was coming. That knowledge alone changed how Bitcoin behaved on pullbacks. That machine was not running on magic. It was running on a very specific financial structure, and that structure is now under severe stress. Here is how the machine actually worked. Strategy raised money by selling preferred stocks to investors who wanted Bitcoin exposure with income. The most important of these is called Stretch. Investors gave Strategy $100 per share and received a monthly dividend of roughly 11.5% per year. Strategy took that $100 and bought Bitcoin. When Bitcoin went up, Strategy's Bitcoin was worth more than its obligations, so it could issue more Stretch shares, raise more money, and buy more Bitcoin. The more Bitcoin it bought, the more Bitcoin went up. The more Bitcoin went up, the more new investors wanted Stretch, round and round. The technical name for this is a reflexive feedback loop. The plain English name is, it works brilliantly when everything is going up, and it starts creaking when things go the other way. Things have been going the other way since October 2025. Bitcoin peaked at $126,000 in October of 2025. It is now at $60,000. That is a 50% drop. Strategy bought most of its Bitcoin at an average price of $75,651 per coin, which means every single Bitcoin on Strategy's balance sheet is currently sitting at a loss on paper. The unrealized paper loss is approximately $13.4 billion as of late June 2026. But here is the thing about the vending machine. When the tokens people are buying start losing value, something very specific happens. New investors stop buying tokens. And without new investors buying tokens, the machine stops having money to buy more Bitcoin. The permanent demand floor that has been under Bitcoin for 3 years starts to disappear. That is not a prediction. That is what is happening right now in real time. In late May 2026, Strategy did something it had not done in 4 years. It sold Bitcoin. Not much, 32 coins, about $2.5 million worth. The size was not the story, the direction was. The machine that had never sold, sold. Marcus stared at that number on his screen for a long time. 32 coins. In isolation, it was nothing. In context, it was everything. To understand why the machine stopped, you need to understand exactly what it was built on. And there is one fact buried in every prospectus that most investors never read. None of Strategy's preferred instruments are collateralized by the company's Bitcoin, not a single one. The Bitcoin is owned by the common equity. Preferred holders have a claim on residual corporate assets only. If Strategy were liquidated today, convertible bondholders get paid first, then preferred holders in order of seniority, and only what is left after all claims are settled belongs to common equity. Preferred holders are standing outside the vault, not inside it. Strategy has 5 preferred instruments. Let me walk you through each one and where they stand right now. Strife, the most senior preferred, pays 10% fixed, currently trading at $84.37. That is 16% below its $100 par value. The instrument that was supposed to be the safest in the stack is now down 16% from where investors bought it. Stretch, the flagship funding vehicle that powered the whole machine, pays 11.5% variable, currently at $74.57, down 26% from par. The at-the-market share program that issued new Stretch shares to raise Bitcoin buying capital is offline. The flywheel has stopped. Strike, the convertible preferred, pays 8% fixed, convertible into common stock at $1,000 per share. With the common trading at $82, that conversion right is worth exactly nothing today. Strike is at $53.57, down 46% from its high. Stride, the most dangerous position in the stack, pays 10% fixed, but the dividend is non-cumulative. If Strategy misses a payment on Stride, that payment is gone forever. It does not compound. It does not get paid later. It simply disappears. Stride is at approximately $51.81, down 48% from par. An investor who bought Stride as a safe income product is sitting on nearly a 50% capital loss with no guarantee of recovering missed dividends. And Stream, the euro-denominated preferred listed on the Luxembourg Stock Exchange. It has no publicly available retail price. It was issued at €80 per share against a €100 par value. It was underwater the day it launched. Every single one of these instruments is now trading below its $100 par value simultaneously, for the first time in this stack's history. Now let us talk about the mathematics that explains why the machine has stopped. Strategy's 5 preferred instruments carry approximately $1.2 billion in annual dividend obligations, up from $300 million at the start of 2026, a 4-fold increase in 6 months. The company's cash reserve sits at $1.4 billion. Cash reserves have fallen 38% since the start of 2026. The margin between what they owe every year and what they hold is $200 million. Think of it like a salary of $140,000 a year while paying rent of $120,000. You are technically solvent, but one unexpected car repair and the maths get very uncomfortable very quickly. And Bitcoin, sitting $15,000 below the average purchase price, is the equivalent of your employer just cutting your hours. Here is the mechanism that made the machine so powerful, and why its absence changes everything. Strategy's entire model was built on something called the mNAV premium, the multiple on net asset value. For 2 years, this ratio was consistently above 1.5 times and sometimes above 2 times. That premium meant Strategy could issue new shares at a price higher than the Bitcoin those shares represented. Every share issued bought more Bitcoin per dollar than it cost to issue. That is what made the flywheel work. That premium has collapsed to 1.03 times. At one point on the 25th of June, it briefly dipped below 1 time. When the market values the company at a discount to its Bitcoin holdings, the accretive machine does not just slow down. It stops being a machine at all. Picture a water wheel on a river. Water flows in, turns the wheel, generates energy, and the energy pumps more water into the wheel. The system feeds itself as long as the river keeps flowing. Stretch above par was the river. Bitcoin appreciation was the energy. New investor demand was the water. The river has dried up. The water wheel has stopped. When the machine stops buying, what happens to the price? To answer that honestly, you need to understand the forces that were hiding behind the machine, because the machine was not just buying Bitcoin, it was absorbing 9 separate headwinds that are now fully exposed. First, ETF panic selling. U.S. spot Bitcoin exchange-traded funds recorded 6 consecutive weeks of net outflows, totaling approximately $6 billion. On the 27th of June alone, $444.5 million left in a single session. When an ETF holder redeems, the issuer must sell the underlying Bitcoin immediately. It is a forced mechanical liquidation regardless of price. Declining prices trigger more redemptions. More redemptions generate more forced selling. The structure that was supposed to bring institutional stability has become an amplifier on the downside. Second, DeFi deleveraging. Approximately $18 to $20 billion in tokenized Bitcoin sits pledged as collateral across lending protocols. When Bitcoin drops through threshold prices, those protocols liquidate automatically. No phone call, no warning, no discretion. Within 24 hours on the 24th and 25th of June, $1.1 billion in leveraged positions were forcibly closed. That cascade has already fired once this month. Bitcoin is still sitting close enough to the next threshold for a second wave. Third, the sailor bid is gone. The machine that absorbed Bitcoin on every dip since 2020 has reversed direction. Strategy has now sold Bitcoin to fund dividends. Polymarket traders are pricing a 98% probability of further Bitcoin sales before the end of 2026. The single most consistent institutional buyer in the history of this asset is not just sidelined, it has flipped. Fourth, the Federal Reserve and real yields. 9 of 18 Federal Reserve Committee members already projected at least one rate hike in 2026. When investors can earn 4 to 5% on risk-free treasury bills, the incentive to hold something volatile with no coupon and no earnings diminishes every single day. Bitcoin has no earnings. Bitcoin pays no dividend. In a high real yield environment, every dollar in Bitcoin has a competitor. Fifth, AI capital rotation. U.S. technology companies are expected to spend more than $700 billion on AI infrastructure in 2026. The institutional dollar that drove Bitcoin from $40,000 to $126,000 has found a competing narrative with visible revenue growth and earnings. Bitcoin has no earnings. In a world where institutional capital is choosing between AI infrastructure and Bitcoin, AI is winning right now. Sixth, miner selling. The April 2025 halving cut block rewards in half overnight. Many miners are now operating at or near their cost of production. They sell into every rally. That creates a persistent ceiling on recovery attempts. Every time Bitcoin pushes towards $63,000 or $65,000, miner selling absorbs the move before it can develop momentum. Seventh, whale distribution. On-chain data confirmed that the number of Bitcoin whales holding 1,000 coins or more peaked in May and has been falling since. 6 entities distributing represents at minimum 6,000 coins, approximately $440 million in concentrated selling in a single week. Whales do not panic sell. They distribute quietly over weeks and months into any strength. Eighth, dollar strength. The US dollar index is holding firm. Bitcoin and the dollar move inversely. Every point of dollar strength is a headwind for Bitcoin priced in dollars globally. And ninth, the Strait of Hormuz. A cargo vessel was struck on the 27th of June. US military conducted retaliatory strikes on the 26th. Oil higher means inflation higher. Inflation higher means the Federal Reserve more hawkish. More hawkish Fed means higher rate hike probability. Higher rate hike probability means Bitcoin lower. It is the same chain from a different entry point, and the Hormuz situation can reactivate the entire sequence with a single headline. Now here is the mathematics most people are not running. Strategy sold 32 Bitcoin in late May to cover one dividend payment. They received $77,135 per coin at the time. Bitcoin is now at $60,000. The same payment at today's price costs 42 coins instead of 32. At $50,000, it costs 50 coins. At $40,000, it costs 63 coins. At $30,000, it costs 83 coins. The selling does not just continue, it accelerates automatically with every dollar Bitcoin falls. The lower Bitcoin goes, the more coins are required to raise the same dollar amount. And every coin sold puts incremental selling pressure on the very asset that determines how many more coins will be needed next month. So here is the question every Bitcoin holder is asking. Is this the death spiral? You deserve a direct answer. No. But the reason why matters as much as the answer. Luna collapsed in May of 2022 because its mechanism was algorithmic and automatic. When the stablecoin lost its peg, the code was forced to mint new Luna tokens. More minting devalued Luna. Devalued Luna forced more minting. There was no human hand on the wheel, no board meeting, no discretionary decision. The code ran until there was nothing left. $40 billion wiped in 72 hours. Strategy is structurally different in one critical way. Strategy's board decides whether to pay the preferred dividend. The prospectus is explicit. Dividends are paid only if the board declares them from legally available funds. There is no algorithm forcing a Bitcoin sale at any price. There is no automatic liquidation trigger anywhere in the $6.75 billion convertible debt portfolio. The Bitcoin is real, held in custody, and nobody can force Strategy to sell it at a specific price. But here is what is true and what most Bitcoin bulls are not saying loudly enough. This is not a death spiral. It is a debt trap, and the difference is time. Luna gave you 72 hours. This gives you months. But the ratchet only turns one direction. Every month Bitcoin stays below $75,651, the financial position tightens. Every month Stretch stays below par, the cost of restarting the flywheel goes up. Every month Strife, the most senior preferred instrument, trades below par, the market is pricing doubt into the entire structure from the top down. The honest assessment from the analysts who have studied this most carefully is this: strategy is not going bankrupt. The Bitcoin is real. The debt maturities are years away. No forced liquidation trigger exists, but the model that powered 3 years of Bitcoin accumulation has broken down. The mNAV premium is gone. The stretch at the market program is offline. The flywheel is not spinning. And the machine that never sold is now selling. On the legal side, 3 law firms are now involved. Rosen Law Firm opened a formal investigation on the 24th of June 2026, examining whether Strategy issued materially misleading information to investors. A separate class action filed in May 2025 is already in the U.S. court system. Retail investors hold approximately 80% of Stretch. The instrument is down 26% from par. The legal question is whether public statements about the instrument cross the line from optimistic promotion into materially misleading representation. That case will take years. But the legal overhang adds a permanent layer of uncertainty to the common stock that did not exist 6 months ago. Marcus closed his laptop at 7 p.m. Sunday evening. He had started the day with a question. What had changed? He had the answer now. The machine that had absorbed every Bitcoin dip for 3 years had stopped. The preferred stack that funded it was cracking from the top down. 9 separate forces were bearing down on Bitcoin simultaneously, and the machine had not just paused, it had reversed. The buyer that never sold was now selling. He did not know what the right decision was for his portfolio. Nobody does right now. But he understood the structure. He understood the connections. He understood what to watch. Bitcoin at $60,000 without the machine underneath it is a fundamentally different market than Bitcoin at $60,000 with it. That is the honest assessment, not a prediction, not a recommendation, just the clearest picture of what is actually happening. The structure is under stress. Now you have it. If this episode gave you a clearer picture of what is really happening underneath the Bitcoin price right now, share it with one person who needs to hear it. And subscribe so you do not miss what comes next. Visit ProfitByFriday.com today. Subscribe free to the Friday Flash, where you will receive one stock fully evaluated through the Clear framework every Friday, so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow. We invest boring to build legacy. See you in the next episode. Bye for now.